Let's look at where those spot rates are. Drewry's World Container Index has Shanghai to Los Angeles just over $6,200 a box, still up 123% on the year, but down 3% on the week. We're talking third week of July. If you're following on YouTube and Spotify, you can see some of these numbers on screen now. Shanghai to New York, bit flat. So Torsten, to you, I'm sure most of your volume on the Transpac moves on contract rather than spot. These contracts are generally signed and sealed by May, June at the latest. Where did you end up on contracts this year? How much have you seen an early peak, a front loading push perhaps while you were negotiating them? And what do you make of the spot market coming off a little bit now?
I think, to the contracting, many of these discussions, of course, start months back. So this is something that's been ongoing in the tender process that typically takes months. Rates this year were slightly lower than they were last year. Last year, we managed to recover some of the cost increases that we have seen. This year, we gave a little bit back. And now, of course, we're in a scenario where the short-term rates are significantly above the long-term rates, which seems to be a trade of the past few years. If you go years back, pre-COVID, there was not a big difference between short and long-term rates as we went through the year. That has significantly changed, and now you can see we have thousands of dollars of difference between the two rates. And this is, of course, also what drives the volatility in the market. And that we see some of the pressure on the short-term rates right now is, of course, that we see extra loaders being deployed and so on. The demand is still there. The bookings I receive on a daily basis is the same as I got a month ago. So there's no abating of the demand, but there's more capacity that has been deployed in the market, especially to the West Coast. So as you pointed out, the East Coast is holding up a little bit better because there is not a significant amount of capacity being injected there. But extra loaders to the West Coast has an impact on the short-term rates right now.
Are you expecting those extra loaders to change? Because we've had a lot of talk about, and we'll go through some numbers and forecasts in a moment with John, but we've had a lot of talk about front loading. We've got some big tariff deadlines as well. You sound quite confident that demand's holding up, irrespective of these recent spot rate declines.
I think that's at least what we hear from our customers, is that this demand will stay at least through August. And then, we'll see how this fans out. Some of them are predicting it to the end of the year, but I think, the prevailing position is that this will last through August, and then it will kind of taper off as we go into the fall.
I'm going to bring the National Retail Federation numbers in shortly on that. But Torsten, obviously this bounce that you're talking about has come through in your Hapag-Lloyd results earlier in July. You guys raised profit forecast for the year, talking about the strong market demand and these rates. EBITDA now forecast, EBITDA, which I always struggle to say, now forecast between $2.7 and $3.7 billion, up from a range that started at 1.1. So how much of that upgrade is real demand? I mean, you sound very bullish on later in the year, but there's so much talk about front loading, or maybe surcharges. Sometimes there's a little bit of a lag on fuel surcharges that can help on that revenue.
I would say, I think in terms of profitability, our long-term rates are barely break even. So we are in a situation where we're not seeing a lot of profit coming through from our long-term contracts. So basically, it's all down to what we can gain from the short-term market. The surcharges we have implemented for the fuel are really, a little bit of a band-aid on things. As you saw, we had the EFS charts in the second quarter. That was just an average and really very small compared to the actual expense that we were faced with. Now we are back to the normal bunker formulas here from the beginning from the third quarter. And yes, that will help some. But as you can see, the volatility is extreme. Now we're seeing oil prices being back about $90 again a barrel. And I mean, 2 weeks ago, it was down to 70. So we are really seeing a lot of volatility here. So unfortunately, it's not the surcharges that's gonna save the day.
Torsten, you mentioned before these extra loaders that are coming into the market. We've also got a lot of new build capacity coming this year and next. Are you worried a little bit? I mean, obviously this comes back to being a global problem, but are you worried about excess capacity maybe even in 2026. And a second question to that, which I feel is slightly linked. There's a lot of talk about blank sailings. Have you guys been blanking many, either your own services or the services or through the Gemini cooperation with Maersk, or are you providing consistency for your customers?
I think, I mean, that's the whole hallmark of Gemini is that we do provide this consistency to customers, and we have no active blanking program. In fact, we try not to have any blanks. We want to provide a seamless service that covers every week. Of course, we do have Chinese New Year, Golden Week, and so on, where there will be. But apart from that, we sail the ships we have, and we don't have enough ships. So we're really struggling just to keep the network together. So this past week with the typhoons in the Pacific. So all that disruption takes a lot of careful handling in terms of we need to omit ports because there's congestion. Then we need to move the containers to a different port in order to pick them up again on the intended ship and so on. Right. So I would say that's quite a lot of work going around. And we certainly are not trying to not have the capacity we have. We're trying to service customers in any way we can. In terms of your first question about the capacity, I think that has been the talk of town over the last 3 years. There's always been this prediction: we're buying too many ships, and eventually it's going to come and hurt us. And I mean, there's some truth to that, obviously, that we are buying a good amount of ships. But I think there's two things that needs to be remembered in this connection here. Number one, the infrastructure in the world is really the limiting factor. We can buy all the ships we want. We can put all the ships in the water we want. It doesn't take long. But if you look at the port capacity, the inland capacity, and so on, that has not changed. So we are looking at infrastructure that cannot handle any more volume as it is right now. If you look at North America, there's not a greenfield project that's been built with a port since Norfolk, Virginia, which was, I think, 30 years ago. So we're looking at infrastructure that is really cannot keep up with this. If they could build infrastructure as fast as we could build ships, there wouldn't be a problem. But that's not the case. The second point I have is that we always look at this. We look at global trade and say our global trade is growing 2%, but supply is growing 5%. Well, what's the real comparison is that you need to look at what is the growth on the dominant legs. So it could be the dominant leg is growing 10%, and the other way it's dropping 10%. And then, conclusion is, well, it's up or down by some percentage point. What you really need to look at is what is the dominant legs? How much are they growing? Because this is what effectively we need to carry. So if Trans-Pacific or Far East Europe is increasing by 10% in the dominant leg, it really requires 10% more capacity, even though maybe that the other leg is dropping. That's not going to help us. We still need to carry that capacity. So I think sometimes it's a little bit skewed in terms of what is the conclusion on how does global trade impact this with the supply.
Thank you, Torsten. I just want to look at a chart here from Alpha Liner on fleet deployment because it intrigued me, and it says something about Hapag-Lloyd that we don't really. I don't think I've ever heard this from you guys when we've done interviews in the past. If you look at the 3 European carriers, if you're on YouTube or Spotify now, we've got MSC, Maersk, CMA, CGM, top 2 trades for all of them: Asia, Europe, and Latin America. Africa also features heavily for these other European carriers, but Hapag-Lloyd stands alone, really, with the Trans-Pacific representing a massive 21% of your business, Torsten, your second biggest trade. How did that come about?
I think chiefly what has happened in the last 2 years is that we got a bit of tailwind from the Gemini network. Not so much because we deployed more capacity, but because we have many more sailings than what we used to have in the past. So our market share on the Trans-Pacific grew from roughly 4% to 7% in a matter of the past year. And of course, that's a relatively robust growth that we almost doubled our. I mean, from 4 to 7, of course, it's not very dramatic from a market perspective, but for us, of course, it was a fairly big growth that we were handed there, and that is what has propelled the Trans-Pacific trade into being one of the bigger trades in Hapag-Lloyd. Of course, keeping in mind that we have basically capacity all over the world, and it just so happens that they may be more balanced in our company than they happen to be in some of the other of our competitors.
I think that brings us to ZIM. Hapag-Lloyd did a big deal with ZIM. It's waiting for that to go through with regulators, maybe later in the year. If you look where ZIM sits on the same chart from Alphaliner, 52% of its capacity on Asia to North America. One of only two carriers in the top 10 putting more than half of its fleet on a single trade. So the European carrier, already unusual for its trans-Pacific exposure, is buying the carrier most concentrated on it. How do you see that playing out, Torsten? I suppose it gives you, well, a lot of options or maybe a lot of power in the future.
I mean, certainly, if and when it comes through, it will be a total game changer for us on Trans-Pacific. So ZIM has more or less the same size as we have today on the Trans-Pacific. So that will then double our share into something to the tune of 13% market share, which will take us into the top 3 of the carriers on the Trans-Pacific. And that, of course, will have a very big impact on our ability to be present with customers, be larger with certain of the bigger customers and so on, right? So yes, it will indeed be a very big change for us if and when this materializes.
Torsten, when we've had quite a surprising year for container shipping, things are going a lot better as your upgrade to your forecast made clear. Is this as good as it gets, or I mean, I guess there's an awful lot of unknowns out here. We don't know what's going to happen in 2027. How upbeat are you?
Well, I think at least this was a welcome surprise, so to speak, that we suddenly saw an increase in demand. As I told you earlier, the long-term contracts we have this year are really at very best break even. So we do need, in order to turn a profit, we do need that we see a meaningful improvement in the short-term market, which we have seen, and that's of course helpful. I would like to see a broader support of this, that we see that also the long-term segment sees an improvement next time around when we do the contracts next time. So if we're able to do that, then I think we should be in a good place. If demand stays where it is, I think there's all the reason to believe that we can do that. If we see a demand that is going in the opposite direction, then we may be in for a difficult year next year.